It is officially over. The moment we have warned you about for years is no longer a prediction. It is our current reality. Shanghai silver just hit $93 per ounce, while the COMEX paper price remains locked at $33. That's a $9 premium, a 27% gap between the price of physical silver in the world's largest physical delivery market and the price of paper silver in the Western manipulation markets. And that gap, the undeniable mathematical proof of fraud, is the smoking gun that destroys 50 years of lies about free market price discovery in precious metals. This isn't a temporary anomaly. This isn't a data error. This isn't explainable by shipping costs or currency fluctuations or regional supply disruptions. This is the final irrefutable evidence that the Western paper-silver markets, the COMEX, the LBMA, the over-the-counter derivatives have been suppressing silver prices through the creation of unlimited synthetic supply, while the real physical market in the East has been reflecting actual scarcity this entire time. The Shanghai Gold Exchange doesn't trade paper promises. It doesn't allow naked short selling. It doesn't permit cash settlement of contracts. Every transaction requires physical delivery within a specified time frame. The SGE is what a real commodity market looks like, where price is determined by actual supply and actual demand for actual metal that actually exists and actually changes hands. And that real market is telling you that silver is worth $93 per ounce. Not 33, 93. Let that number sink in. While Western investors, pensioners, and savers have been told by their financial advisors that silver is trading at $33, while the mainstream media has ignored precious metals entirely, while the bullion banks have continued their manipulation schemes with impunity, the largest physical silver market in the world has been paying nearly 3 times the Western paper price. The wealth transfer isn't theoretical anymore. It's visible, documented, and accelerating. Chinese buyers, Indian buyers, Russian buyers, Middle Eastern buyers, they've been paying premiums to acquire physical silver because they understand what Western institutions have been desperately trying to hide. Silver is far more scarce than the paper price suggests. And when the paper fraud finally collapses, the reset to physical prices will be instantaneous and catastrophic for anyone holding paper claims. But before we explore the implications of this $9 gap, we need to understand exactly how we got here. Because this didn't happen overnight. This is the culmination of decades of manipulation, suppression, and fraud, and the Shanghai Premium is simply the market's way of exposing what informed observers have known for years. Let me take you back to the architecture of the silver manipulation scheme, because understanding the crime is essential to understanding why Shanghai's $93 price is the dagger in the heart of the system. The Western silver market operates on a fractional reserve model, identical in structure to fractional reserve banking. The COMEX Futures Exchange and the London Bullion Market Association create paper claims on silver futures contracts, forward contracts, unallocated accounts, ETF shares that far exceed the actual physical silver held in vaults. The ratio of paper claims to physical metal is estimated to be anywhere from 100 to 1 to 500 to 1, depending on whether you include over-the-counter derivatives and bank obligations. This scheme works as long as most participants settle in cash rather than demanding physical delivery. The speculators who dominate these markets are happy to take profits or losses in dollars without ever touching an ounce of silver. The paper price, determined by the marginal buying and selling of these paper instruments, becomes the price, even though it has no connection to physical scarcity. The bullion banks J.P. Morgan, HSBC, Scotia, UBS act as market makers and often take the short side of these paper contracts, effectively selling silver they don't have. They profit from the spread, from the fees, and from the ability to suppress prices and accumulate physical metal at artificially low levels. Central banks tolerate or even encourage this manipulation because rising gold and silver prices signal inflation, currency debasement, and loss of confidence in fiat money signals that undermine their monetary policy credibility. For decades, this system functioned smoothly. Western price discovery dominated global markets. The Shanghai Gold Exchange, launched in 2002, and the Shanghai Futures Exchange were viewed as regional markets that would eventually align with Western prices through arbitrage. But something unexpected happened. The Eastern markets didn't converge to Western prices. Western prices are being forced to acknowledge Eastern reality. China, India, Russia, and Middle Eastern buyers started demanding physical delivery at unprecedented rates. The Shanghai Gold Exchange began trading more physical gold volume than the COMEX and LBMA combined. And because Shanghai requires physical settlement, the price discovered there reflects actual physical scarcity rather than paper manipulation. The same dynamic that transformed the gold market is now transforming silver. And the $93 Shanghai price is the moment when that transformation became undeniable. Here's why the $9 premium is so significant and why it's not just about arbitrage opportunity, but about the complete breakdown of the Western price suppression system. In a functioning market with efficient arbitrage, a $9 premium shouldn't exist for more than hours or days. Arbitrageurs would immediately buy silver on the COMEX at $33, ship it to Shanghai, and sell it for $93, pocketing the $9 spread minus shipping and financing costs. That arbitrage activity would drive Western prices up and Eastern prices down until the gap closed to transportation and insurance costs, perhaps 50 cents to $1 per ounce. But the gap isn't closing, it's widening. And it's persisting for weeks, not days. Why? Because the arbitrage that should close the gap requires one critical component: available physical silver in the West to buy and ship east, and that physical silver doesn't exist in sufficient quantities. The COMEX registered inventory silver available for delivery against futures contracts currently sits at approximately 47 million ounces. That sounds like a lot until you realize that open interest on COMEX silver futures represents over 1 billion ounces in paper claims. And until you realize that 47 million ounces represents less than 6 days of Chinese silver demand based on their industrial consumption and investment buying. The LBMA is even more opaque. They don't publish daily vault inventories. They operate on an unallocated fractional reserve basis where multiple claims exist on the same physical bars. And they're now reporting allocation delays measured in months, not days, for clients trying to convert paper claims to physical metal. So when arbitrageurs try to buy silver in the West to ship to Shanghai to capture that $9 premium, they discover that the silver either is unavailable at spot price, dealers are demanding premiums of $5 to $8 over spot, even in the West, or it's available, but with delivery delays of weeks to months that destroy the arbitrage profitability because of financing costs and price risk. The $9 Shanghai premium is the market's way of saying, Western paper prices are fraudulent. Physical silver is far more scarce than paper markets suggest, and the only price that matters is the price in markets that require physical delivery. And here's the truly terrifying implication. If Shanghai is at $93 and Western paper is at $33, what's the true global price of silver? Is it $33, with Shanghai being an outlier? Or is it $93, with Western paper being the outlier? The answer is obvious. Physical settlement markets reflect reality. Paper markets reflect manipulation. And when the two diverge by 27%, the paper market is the lie. Let me give you the data that proves this isn't a Shanghai anomaly, but a global physical premium phenomenon. In India, the second largest silver consumer in the world, premiums on physical silver bars and coins are running $8 to $12 over the Western spot price. In Singapore, premiums are $6 to $10. In Dubai, premiums are $7 to $11. Even in Europe, which is geographically closer to the LBMA, premiums have spiked to $4 to $7 per ounce. Every physical delivery market in the world is trading at significant premiums to the Western paper price. The only markets trading at or near the paper price are the markets that don't require physical delivery, the COMEX futures, that settle 98% in cash. The LBM, a forward market that operates on unallocated fractional reserves, the ETFs that hold questionable inventory with unclear audit standards. This is the global market screaming that the emperor has no clothes. that the silver supposedly backing all these paper claims doesn't exist in the quantities claimed, and that the true price of obtainable, deliverable silver is far higher than Western institutions want to admit. Now let's talk about the mechanism driving Shanghai to $93, because this isn't just about Chinese buyers paying irrational prices. This is about fundamental supply and demand in the world's largest manufacturing economy and fastest growing investment market. China consumes approximately 210 million ounces of silver annually in industrial applications, electronics, solar panels, automotive, chemicals, batteries. This industrial demand is completely inelastic. Factories can't shut down production lines because silver prices rose. They can't substitute away from silver without years of research, development, and retooling. They have to buy silver at whatever price the market demands, or they stop producing. On top of industrial demand, Chinese investment demand for silver has exploded. The Shanghai Gold Exchange reported record silver withdrawals in 20-20-4 over 150 million ounces withdrawn from vaults for private ownership. That's investment demand that removes metal from the available supply permanently until those investors decide to sell, which in a culture that views precious metals as generational wealth means potentially decades or never. So you have approximately 360 million ounces of total Chinese demand industrial plus investment against global mine production of 820 million ounces. China alone is consuming 44% of global silver production, and they're not the only buyer. India consumes another 190 million ounces. The United States, Europe, and the rest of Asia consume the remainder. The supply is already in deficit before you account for the fact that most silver is produced as a byproduct of copper, lead, and zinc mining. Primary silver mines represent only about 30% of global production. If copper prices fall, or if base metal mines close due to economic conditions, silver supply contracts regardless of silver prices. This supply inelasticity means that even at $93 per ounce, you can't significantly increase silver production in the short to medium term. China understands this arithmetic. They understand that silver is strategically critical to their manufacturing dominance, to their renewable energy ambitions, to their technological advancement, and they understand that the Western paper price is artificial and temporary. So Chinese buyers are willing to pay $93 per ounce on the Shanghai Gold Exchange because that's the price required to secure physical delivery in a market where demand exceeds supply and where trusting Western paper markets to deliver metal has proven to be a catastrophic mistake for anyone foolish enough to try. The Shanghai premium isn't irrational, it's the rational response to Western fraud. Let me explain the arbitrage flow that's happening right now and why it's accelerating the collapse of the Western system. Every ounce of physical silver that can be extracted from Western vaults and shipped to Shanghai is being extracted and shipped. Dealers are buying from retail sellers, from investors liquidating positions, from industrial users willing to draw down inventory. That silver is immediately shipped to China, Hong Kong, Singapore, anywhere that physical premiums justify the transportation and financing costs. This flow is draining Western inventories at an accelerating rate. The COMEX registered inventory has fallen from over 100 million ounces in 2022 to 47 million ounces today. LBMA vault holdings, to the extent they're accurately reported, which is questionable, have declined by an estimated 200 million ounces since 2020. Where did that silver go? East, to Shanghai, to Mumbai, to Singapore. And it's not coming back. This is the same dynamic that played out in the gold market over the past 2 decades. Western central banks leased out their gold, bullion banks sold it, and it flowed to Eastern buyers who took physical possession. The leased gold that's supposed to be returned to central banks is gone sitting in private vaults in China and India. The central banks still claim it on their balance sheets as assets, but the actual metal is no longer in their possession or control. Silver is following the same path, except the timeline is compressed. What took 20 years in gold is happening in 2 to 3 years in silver because the market is smaller, the leverage is greater, and the physical deficit is more severe. While the masses remain distracted by the noise, by the political theater, by the manufactured crises designed to keep them looking anywhere. But at the monetary system, this community of stackers understands that wealth isn't destroyed, it's transferred. Your presence here, your comments, and your commitment to the truth are what keep this movement alive. You are the informed, the prepared, the resilient minority who understood that East and West are not playing the same game, that physical and paper are not the same asset, and that when the divergence becomes undeniable, it's the paper that evaporates and the physical that prevails. Every ounce you hold in physical possession is an ounce that is not available for the bullion banks to deliver against their fraudulent paper obligations. Every coin in your stack is one less coin that can be arbitraged to Shanghai to close the premium gap. You not just protecting your own wealth, you actively participating in the destruction of a fraudulent system by removing physical supply from their control. The $9 Shanghai premium is your vindication. It's proof that you were right to ignore the paper price and focus on accumulating physical metal. It's confirmation that the conspiracy theories about manipulation were actually documented fact. And it's just a preview of what happens when the paper markets finally collapse and the only price that matters is the physical price. But let's dig deeper into what the $93 Shanghai price actually represents, because it's not just about current supply and demand, it's about the market pricing and future scarcity and monetary system collapse. Shanghai buyers aren't just paying $93 for today's industrial needs. They're repaying $93 because they understand that silver availability at any price is not guaranteed in the near future. They're front-running the shortage. They're repositioning ahead of the inevitable supply crisis that occurs when paper markets default and physical-only trading becomes the global standard. Think about the psychology of a Chinese manufacturer who relies on silver for electronics production. If they believe based on allocation delays, premium explosions, and inventory data that silver might become unavailable at any price in 6 months, what do? They buy 6 months or 12 months of inventory now, regardless of price, because the cost of not having silver and shutting down their factories is catastrophically higher than paying a premium today. This inventory hoarding behavior creates a self-reinforcing feedback loop. The more buyers hoard, the tighter physical supply becomes, which validates the hoarding behavior and encourages more of it. This is the classic commodity supercycle psychology, except it as compressed into a time frame measured in months instead of years because the underlying deficit is so severe. And it's not just Chinese manufacturers. The Chinese government, through state-owned enterprises and sovereign wealth vehicles, is also accumulating silver strategically. Just as they've been accumulating gold for the past 2 decades, building reserves for a post-dollar monetary system, they're accumulating silver for industrial security and potential monetary backing of a commodity-linked yuan or BRICS currency. The People's Bank of China doesn't publish silver reserve data the way they publish gold reserves. But trade data, refining data, and mine production data all point to the same conclusion. China is producing approximately 200 million ounces of silver annually from domestic mines and refining. They're importing another 300 million ounces through Hong Kong and direct imports, and they're exporting less than 50 million ounces. That means approximately 450 million ounces are being consumed or accumulated within China annually. 450 million ounces is 55% of global mine production, one country, consuming and accumulating more than half the world's silver output, and paying $93 per ounce to do it. What happens when the rest of the world wakes up to this reality? What happens when American manufacturers, European industries, and emerging market buyers realize they've then been lulled into complacency by artificially low paper prices, while China has been securing physical supply at any cost? The panic buying begins. The allocation delays that are currently measured in weeks extend to months and then to unavailable at any price. The Western paper markets, unable to deliver physical metal against the tsunami of delivery demands, declare force majeure or implement cash settlement at paper prices while physical trades at multiples of paper. A fraud is exposed, and the Shanghai price becomes the global price. This is the endgame we've been warning about. And the $9 Shanghai premium is telling you we're in the early innings of that endgame. Now let us address the mechanisms by which the Western institutions are trying to defend the indefensible paper price. In the face of this Shanghai reality, the COMEX and LBMA can allow prices to converge to Shanghai levels without admitting that their markets have been fraudulent. A sudden jump from $33 to $93 would trigger margin calls that would bankrupt multiple bullion banks, would expose the insolvency of ETFs that claim to hold metal they don't have, and would destroy confidence in Western financial markets generally. So they're employing every tool in the manipulation playbook to maintain the illusion. Coordinated paper selling ***. Bullion banks dump massive quantities of paper futures contracts during low liquidity trading hours, typically Sunday evening when COMEX opens, or during Asian trading hours when Western participants are asleep. These coordinated dumps, often totaling hundreds of millions of ounces in paper equivalent, drive prices down temporarily and create the appearance that silver demand is weak when the reality is the opposite. Margin requirement increases ***. When physical delivery demands increase and threaten to drain COMEX inventories, the exchange raises margin requirements, making it more expensive for traders to hold positions demanding delivery. This forces some traders to close positions, reducing delivery pressure. Yes, the same tactic they used against the Hunt brothers in 1980 and against retail buyers during the Reddit squeeze in 2021. Cash settlement incentives ***. The COMEX offers traders financial incentives to settle contracts in cash rather than taking delivery. They might offer a spot price plus a premium, which is cheaper for them than scrambling to find physical metal to deliver. Some traders accept because the premium is attractive. Others refuse because they want the metal, understanding that its true value is far higher. ***, inventory, shuffling ***. When registered inventory falls to dangerously low levels, silver is transferred from eligible inventory to registered inventory to create the appearance that deliverable supply remains adequate. But this is an accounting trick. The same metal is being reclassified, not added to. And it has a finite strategy because eligible inventory itself is shrinking as metal is withdrawn from vaults entirely. LBMA opacity ***. The London Bullion Market Association doesn't publish daily vault inventory numbers the way COMEX does. This opacity allows them to avoid the scrutiny that would reveal how fractional their reserves actually are. Clients demanding allocated silver are being told to wait months, but there's no public data forcing accountability. Media blackout ***. The mainstream financial media ignores the Shanghai premium entirely. CNBC, Bloomberg, The Wall Street Journal, they do uncover it because explaining a $9 gap would require admitting that Western markets are fraudulent. The silence is complicity. But here's the critical point. None of these tactics can change physical reality. They can delay the reckoning. They can manage the optics. They can manipulate the paper price for weeks or months longer. But they can't create silver that doesn't exist, and they can't prevent Eastern buyers from continuing to drain Western inventories at paper prices that are $93 below what those buyers are willing to pay. The arbitrage will continue until Western vaults are empty or until Western prices rise to eliminate the profit opportunity. And since the vaults are finite and the demand is structural, the outcome is predetermined. Western prices will be forced higher. The only question is whether the adjustment happens gradually or catastrophically. The $9 Shanghai premium suggests we're heading toward catastrophic. Let me give you the historical parallels that show why this Shanghai premium is different from previous disconnects and why this time the reset is permanent. In 2008, during the Great Financial Crisis, physical silver premiums spiked temporarily as investors panicked into hard assets. Silver Eagles traded at $7 to $10 premiums. But those premiums collapsed within months as the panic subsided and the Fed's liquidity injections stabilized markets. The paper system survived because trust was restored, or at least enough trust remained to keep the game going. In 2011, when silver reached $49 per ounce, premiums were elevated, but not extreme because the price rise itself attracted new supply from recycling and from investors willing to sell at those levels. The system was under stress, but there was still enough physical float to satisfy demand. In 2020, during the COVID lockdowns, premiums exploded again as mints shut down and retail demand surged. Silver Eagles traded at $10 to $15 premiums, but this was viewed as a temporary supply chain disruption rather than a structural shortage. The system bent but didn't break, but 2025 is different. The Shanghai premium isn't a panic-driven spike that will normalize when fear subsides. It's a rational reflection of physical scarcity in the world's largest physical delivery market. It's persistent, not temporary. It's widening, not narrowing, and it's spreading to other physical markets globally. This is the signature of a systemic breakdown, not a temporary disruption. And the fact that Western institutions can't arbitrage it away despite the obvious profit opportunity tells you that the problem is insolvency, not illiquidity. They don't have the metal to sell, so they can't capture the arbitrage. The vault is empty, but they're still issuing receipts. Now, let's talk about the implications for different participants in this market, because the Shanghai premium creates winners and losers on a scale that will reshape the global financial landscape. Asterisk, asterisk winners. Asterisk, asterisk. Physical holders, asterisk, asterisk. Anyone who owns physical silver in their possession is now holding an asset that trades at $93 in the world as largest physical market, while Western institutions are still valuing it at $33 on paper. You can't sell directly on the Shanghai Exchange as a foreigner, but the convergence is inevitable. Either Shanghai comes down or Western paper comes up. Given the physical scarcity, the latter is far more likely. Your silver is worth more than your brokerage statement suggests. Asterisk, asterisk, Eastern buyers, asterisk, asterisk, China, India, Russia. Middle East, any buyer who understood that the Western price was fraudulent and accumulated physical at $30 to $40 over the past few years is now sitting on gains of 100 to 200% as Eastern markets reflect reality. They're also positioned to survive and thrive in a post-dollar monetary system where commodity-backed currencies dominate. Miners, asterisk, asterisk. Silver miners with actual production and reserves are now one of the most compelling investment opportunities in decades. If the physical silver price is $93 and will likely go higher as shortages intensify, miners producing silver at $15 to $25 per ounce all-in costs are printing money. The catch is that most silver comes from byproduct production, so pure-play silver miners are rare and small. But those that exist will see explosive earnings growth. Refiners, asterisk, asterisk. The entities that convert door bars from mines into investment-grade or industrial-grade silver are now absolutely critical choke points in the supply chain. And China controls 60% of global refining capacity. This gives them enormous leverage over global supply chains and pricing. Asterisk, asterisk, losers. Asterisk, 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 paper silver holders, asterisk. Anyone holding silver through ETFs like SLV. Unallocated LBMA accounts or futures contracts is holding a claim on metal that increasingly appears not to exist. When the default occurs and the Shanghai premium suggests it is imminent, these paper claims will settle at Western paper prices while physical metal trades at Eastern physical prices. The wealth destruction will be catastrophic for those who thought they owned silver but actually owned IOUs. Asterisk, asterisk, bullion banks, asterisk, asterisk. JP Morgan, HSBC, Scotia. Any bank with net short positions or fractional reserve obligations on silver is facing potential insolvency if prices rise to Shanghai levels. A $60 increase from 33 to 93 on a short position of 100 million ounces is a $6 billion loss. Asterisk, asterisk, Western central banks, asterisk, asterisk. The Federal Reserve, European Central Bank, Bank of England central banks that have tolerated or encouraged precious metal suppression to maintain fiat currency credibility are about to watch that suppression fail spectacularly. Rising gold and silver prices signal inflation and currency failure. The Shanghai Premium is the early warning that their manipulation scheme is ending and their currencies are next. Asterisk, asterisk, Western savers, asterisk, asterisk. Anyone who trusted the traditional financial system, who held bonds and stocks and dollars instead of hard assets, is about to discover that the purchasing power of their savings has been systematically destroyed. As silver and gold rise to reflect physical reality, the dollar value of everything denominated in dollars falls proportionally. This is the wealth transfer playing out in real time. The $9 Shanghai Premium is the line of demarcation between those who understood physical reality and those who trusted paper promises. And that line is about to become a chasm. Let me address the most common counterargument to the Shanghai Premium thesis, because intellectual honesty requires engaging with the strongest opposing view. The critics say the Shanghai Premium is just Chinese capital controls and import restrictions creating artificial scarcity within China. It's not a true market price because Chinese buyers can't easily access Western markets, and Western sellers can't easily access Chinese buyers. Once those barriers are removed through trade agreements or policy changes, prices will converge back to Western levels, not the other way around. This argument has superficial plausibility but collapses under scrutiny. First, the premium isn't limited to China. India, Singapore, Dubai, Europol showing significant physical premiums over Western paper. If this were purely a Chinese capital control issue, the premium would be isolated to Shanghai. It's not. It's global. Second, arbitrage is happening despite capital controls. Dealers are shipping metal east and capturing the premium. If the premium were truly artificial and unsustainable, arbitrage would close it. The fact that arbitrage is occurring, but the premium is widening, tells you that demand exceeds the available supply at the Western price. Third, the assumption that prices will converge to Western levels rather than Eastern levels presupposes that Western prices are real and Eastern prices are distorted. But which is more likely to be real? The price in a market requiring physical delivery, or the price in a market that's 98% cash-settled paper? The answer is obvious. Fourth, even if capital controls are a factor, they're not temporary. China's capital controls are structural and intentional. They're designed to protect the domestic economy from Western financial manipulation. Those controls are going away. They're likely to tighten as the financial war between East and West intensifies. The Shanghai Premium isn't an artifact of policy distortions. It's the market revealing that Western paper prices have been the distortion all along. Now let's explore the timeline for convergence, because this is the critical question for anyone trying to position ahead of the reset. The $9 premium exists today. How long can it persist before triggering a catastrophic adjustment in Western markets? The answer depends on how fast Western inventories are drained and how quickly Western institutions lose control of the narrative. COMEX registered inventory is currently at 47 million ounces and declining at approximately 2 million ounces per month as delivery demands exceed new supply. At that rate, registered inventory hits zero in approximately 23 months, roughly 2 years from now. But that's a linear extrapolation, and these processes are rarely linear. They're exponential. As inventory falls and shortages become more obvious, delivery demands accelerate. More traders stand for delivery instead of rolling contracts forward. More investors lose faith in paper and demand physical. The drain accelerates from 2 million ounces per month to 4 million, then 6 million, then 8 million. At an accelerating drain rate, COMEX registered inventory could hit critical levels, let's say 10 million ounces, which is less than 2 weeks of global demand within 6 to 12 months. What happens then? The COMEX has several options, all bad. Asterisk, asterisk, option 1. Declare force majeure, asterisk, asterisk. Suspend trading. Claim an act of God or unforeseeable circumstances and settle outstanding contracts in cash at the paper price. This would expose the fraud definitively and destroy confidence in Western precious metals markets permanently. Shanghai becomes the global price discovery venue. Option 2. Implement cash settlement rules ***. Change the rules to prohibit physical delivery or make it economically unattractive through massive fees or margin requirements. This is less dramatic than force majeure, but achieves the same result: paper and physical separate permanently, and the paper price becomes irrelevant. Option 3. Allow prices to rise ***. Let Western paper prices rise to eliminate the arbitrage opportunity with Shanghai and to ration demand. This is the least disruptive option, but requires Western institutions to admit that silver is worth far more than they've been claiming, which triggers losses on short positions, losses for anyone who sold physical at suppressed prices, and loss of credibility for the entire system. My assessment is that they'll try option 3, allowing gradual price increases until that becomes untenable, at which point they'll implement option 2 as a damage control measure. Option 1, outright default, will only happen if they run out of time and have no other choice. But regardless of which path they take, the outcome is the same. The paper price converges to the physical price, not the other way around. And that physical price, as Shanghai is showing us today, is $93 and rising. The timeline is measured in months, not years. And every week that passes with the premium persisting or widening is another week closer to the moment when the reset happens. Let me give you the data points to watch that will tell you we're reapproaching the critical threshold. ***1. COMEX registered inventory ***. When this falls below 20 million ounces, panic begins. Below 10 million, default is imminent. 2. Shanghai premium expansion ***. If the premium widens from $9 to $12 to $15, it indicates accelerating arbitrage failure and physical scarcity. ***3. LBM allocation delays ***, currently at weeks to months. When these extend to unavailable at any price, the game is over. 4. Retail premiums in the West ***, currently at $5 to $8 over spot for generic products. When these reach $10 to $15 over spot, it means Western physical markets are converging to Shanghai levels. 5. ETF inventory changes ***. If SLV or other major silver ETFs see massive outflows or report inability to acquire physical silver to back new shares, it's a sign that the paper structure is collapsing. 6. COMEX delivery defaults ***. The first time a major trader or bank fails to deliver physical silver against a futures contract and is forced to settle in cash, the precedent is set that physical delivery is no longer guaranteed. That's the moment paper and physical separate permanently. Watch these indicators. When multiple indicators hit critical levels simultaneously, the reset is imminent. Now, let's talk about what the $93 Shanghai price means for the broader economy and the monetary system, because this isn't just about silver, it's about the collapse of dollar hegemony and the Western-led financial order. Silver, like gold, is a thermometer for monetary system health. When silver prices rise dramatically, it signals that investors are losing confidence in fiat currencies and fleeing to hard assets. The Shanghai premium is the Eastern markets sending a message to the West. Your dollar is failing, your bonds are toxic, your monetary policy is reckless, and we're protecting ourselves by accumulating tangible assets that can't be printed, debased, or confiscated remotely. China, a willingness to pay $93 per ounce for silver while the West clings to $33 paper prices is a direct challenge to Western financial dominance. It's China saying, we don't accept your price discovery. We don't trust your markets, and we're building an alternative system based on physical settlement and commodity backing. This is the same message they sent when they launched the petro-yuan oil contracts denominated in yuan and convertible to gold on the Shanghai Exchange. It's just the same message they're resending with BRICS currency discussions and bilateral trade agreements that bypass the dollar. The theme is consistent: de-dollarization through commodity-backed alternatives, and silver, being more accessible than gold for average investors and more critical for industrial supply chains, is the perfect vehicle for this challenge. If China can break the Western silver market by forcing physical delivery at prices that expose the paper fraud, they've proven that Western price discovery is illegitimate and that alternative systems are necessary. The geopolitical implications are staggering. Western militaries depend on silver for missile guidance systems, radar, electronics. Western industries depend on silver for manufacturing competitiveness. Western investors depend on silver as a hedge against currency debasement. And all of it is being systematically transferred east at prices that don't reflect true scarcity. Because Western institutions continue to live in a fantasy world where paper claims are equivalent to physical metal. This is not just a market failure, it's a strategic failure of historical proportions. And future historians will point to the Shanghai silver premium of 2025 as one of the key indicators that the West had lost its grip on global economic leadership. The $9 gap isn't just about $9. It's about the emergence of a multipolar world where the West no longer dictates prices, where physical settlement replaces paper promises, and where centuries of Anglo-American financial dominance come to an end. For those paying attention, the message is clear: position yourself on the side of physical assets, Eastern accumulation, and monetary reset. Or remain trapped in Western paper and watch your purchasing power evaporate as the system collapses around you. The choice has never been more obvious. The Shanghai premium has made it impossible to ignore. Let me close with the practical action steps, because information without action is just entertainment. If you hold silver ETFs, unallocated accounts, or futures positions, convert to physical immediately. The Shanghai premium is warning you that paper settlement may not deliver actual metal. If you have allocated silver in professional storage, verify that it actually exists. Request a specific bar list. Demand serial numbers. Consider taking delivery if economically feasible. The $9 Shanghai premium is telling you that silver is undervalued by at least 27%, probably far more. If you've been waiting for a pullback to buy more, you're misunderstanding the dynamics. This isn't a pullback market, it's a runaway freight train. Don't keep all your metal in one location. Western governments have confiscated gold and silver before. Executive Order 6102 in 1933. They can do it again. International storage, home safes, bank deposit boxes spread the risk. The Shanghai premium indicates that at current Western prices, supply is about to become unavailable. Buy what you can now, even at elevated premiums, because 6 months from now, you may not be able to buy at any price.